Hi, and welcome to my channel. For those of you new, these videos will be a mixture of tracking my journey and development towards financial freedom, about basic personal financial products, and also about improving people's financial well-being. My name's Dave and I work in financial services, and it amazes me the number of people I speak to on a day-to-day through my employment who do not understand the basics of personal finance because we don't teach the subject in schools, or in the UK we think the subject matter is taboo to talk about. Remember, if you like the videos in this channel, press the like button, subscribe to this channel so it can grow and reach a wider audience. Now let's get on to this week's video. So this week's video is about a review of my SIPP account, so my self-invested personal pension. Hopefully give you an idea of the aims of the portfolio to hopefully reach a successful retirement later on in life. Now, it's not to boast or brag, it's to give people a view of my investment journey and the reasons we hold the shares, the values, contributions, dividends, etc. Now, it's not a quick, rich portfolio. The aim is long-term growth. This year for the portfolio, we're looking for a growth rate of 10%. We're looking for annual dividends of £3,000 and a year-end value of £90,000. So let's dive into the figures. So as we can see from the start of June, the valuation was £89,889. We finished the end of June at £90,423. A nice profit of £534. Now up to the end of May, year-to-date return was 22.98%. And the end of June, we were at 23.77%, so far in excess of our plans of 10%. Now, I know growth rates will not continue in future, it will die down in markets, but the portfolio is doing much better than we anticipated at the start of the year. Now, in relation to contributions, we make a normal monthly contribution of £100 a month. We receive tax relief from the government of 25%. And for the month of June, we've received the following dividends of £93.45. So we received a dividend, quarterly dividend from BP of £18.55. We received a dividend from Shell of £18.39 and a nice dividend from Morrison's £56.61, which we reinvested and gave us 23 new shares. Now, we have 17 shares in the portfolio, I will address in a minute, but the average yield across our holdings is 2.43%. And our SIPP provider charges monthly fees of £13.54. Now, if we look at the portfolio, 47% is in financial services, 17% is in consumer defensive, 9% is in consumer cyclical, 8% in utilities and 6% in technology. Now, the fund is predominantly UK based. 86% is based in the UK, 11.5% is in the US and 2.5% is in Asia. And if we look at the shares, we hold 17 shares, 10 in profit, 7 in loss. Our total shareholdings are worth £72,338, round about 80% of our portfolio, of which 65% is in the FTSE 100 and 15% is in the FTSE 250. Look at our shareholdings, we hold 17 shares, 10 are in profit, 7 in loss. Now I'm not going to run through all the shareholdings, but just an overview of our largest shareholdings and the reason we hold them. So our largest shareholding is Aviva. We own 3,993 shares, £16,000, 18% of our portfolio, showing a nice profit since we bought it of 3%, but it actually did increase for the month of June of £736. So a very nice share, but because of its credentials, it has recent restructuring, but it does have a good growth dividend, currently yielding about 5.5%. Our next shareholding is Lloyds. We own 31,308 shares, £14,500, 16% of our portfolio, down about 5%, but During the month of June, it has lost 6% during this month, so we were in profit before the start of the month. Our next biggest shareholding is Greggs. We own 266 Greggs, roughly £6,900, 8% of our portfolio, but a very nice profit, up 114% since we bought it. It did have very good trading statement during the month, and it will be back in profit, and hopefully moving forwards, dividends will be reinstated, and also a special dividend. Our next shareholding is Barclays. We own 2,797 shares, £4,800, 5% of our portfolio, a loss of 7%. Hopefully good results during the month of July. Dividends will be reinvested, and hopefully when the sentiment recovers, like a lot of our banking stocks, will produce good margins, good dividend yields, but a long-term hold. Our next shareholding is Drax, the power plant, the biomass producer. We own 1,156 shares, £4,800, 5% of our portfolio, up 64%. But a very good long-term shareholding, has been on a recent buying spree recently, is a growth company, is cash rich. Our next shareholding is JD Sports, 500 shares, £4,500, 5% of our portfolio, showing a very nice profit of 145% since we bought it. Does pay a very small dividend due next month, but it is ultimately a growth company. Has been on a recent buying spree in America and Europe, but it is very cash rich. It does have a very good online presence and a high street presence, but the aims of that portfolio is growth moving forwards, and again it did have a very good trading statement during the month. And then right down to our smallest shareholding, John Menzies, the aviation services. We own 252 shares, £787, makes up just under 1% of our portfolio, a loss of 21%. It was bought because of its services, but moving forward, aviation sector will hopefully recover, but a long-term shareholding. Now, during the month, we did make contributions, we did receive dividends, we did make one purchase. We bought 43 shares in HBOS, or HSBC, of £191. But the most probably telling information for the month was the supposed takeover from Morrison's. A share price was offered of £2.54. We started the month at £1.70, so a nice profit. We don't know what's going to happen moving forward. It's going to be a nice bidding war, but at the moment it makes up about £3,000 of our portfolio. So hopefully we'll see what happens with it moving forwards, and then depending on what happens, we will obviously, if it does get taken over, we will invest some shareholdings or profits into existing holdings to obviously diversify our funds a bit more. So a quick summary: 17 shares, very nice profit across the board. Other shares we do hold: we hold Pennon, the water company, we own AG Bar, we own Card Factory, BP, Shell. Now moving on to our funds held within the portfolio. We own 6 funds within the portfolio. £18,085 makes up about 20% of our portfolio. Now, all 6 funds are in profit, and all 6 funds are what we call actively managed funds. So they've all been chosen for hopefully long-term growth and very good outperformance to beat passive funds on the market. We are prepared to do our research. We are prepared to pay extra in fees, because hopefully the rewards will give us our aims of reaching 10% year-on-year growth. So a quick summary of our 6 funds. Our largest shareholding is a Legal and General Technology Fund, £4,500, makes up 5% of our portfolio, showing a very nice profit of 50% since we bought it. And the month of June, we made a nice profit of £350. Everything in America seems to be growth rich for the FANG stocks. Hopefully it will continue. You may not see the growth rates moving forwards, but it's been bought for diversification, and it seems to be a very good sector in the past few months. Who knows what happens moving forwards, but a long-term hold. Our next shareholding is quite selective. It's a Ballet Gifford Positive Change. £3,660, 4% of our portfolio, 34% profit since we bought it. Does have a very few select number of shares or holdings, but all good quality companies. And during the month of June, we made a nice profit of £400. Our next holding is a global equity fund, £3,500, 4% of our portfolio, a return of 16%. It was bought for diversification to get us away from the UK, to give us a lot more allocation across the world, but hopefully a very good growth performance in future. And for the month of June, we made a profit of £395. Our next fund is a US smaller companies, £2,750, 3% of our portfolio, a very nice return of 37% since we bought it. Very small profit of the month of £45, but we've got good sentiment towards the US. Hopefully the smaller companies will grow to become bigger companies, but so far to date a very good return. And hopefully the same scenarios will happen moving forwards. Our next holding is Lindsell Train UK Equity, £2,700, 3% of our portfolio, a return of 7%. Lindsell Train has a very good track record in the UK, quite selective on the number of holdings it has, but again, all good quality long-term holdings. Hence the reason we bought it, because of past performance and a very good track record, giving good compounded growth year on year. And finally, our smallest shareholding is UK smaller companies, £1,070, 1% of our portfolio, a growth rate of 7%. Now, hopefully in the UK, after the pandemic settles down, recovery in place, UK smaller companies will hopefully give us greater growth than the FTSE 100. So it was bought for diversification and hopefully will exceed the 10% returns, which may offset off the other sectors, but it was bought for diversification, and I firmly believe there's more growth potential within UK smaller companies than the FTSE 100. So quite a mixture of sectors there. Now, all the funds we hold, as we said, are actively managed. They are all long-term shareholdings or fund holdings, so we aim to hold them in the next 3 to 5 years, unless market sentiment changes or the management of them funds change. And moving forwards, we may well top it with existing funds, depending on our aims on our diversification. So overall, a quick summary. Between our funds and our shareholdings, okay, we own 23 holdings, quite diversified, but for the year to date, a very nice performance of 23.77%, well in excess of 10%. So as we said, the aim of the fund is 10% return year on year. It's not a get-rich quick scheme. It is a fund to fund our retirement at a later date in retirement. Now remember, if you like the videos, smash the like button, and we'll see you again soon for our next video.